Moving on to identifying and evaluating ESG-related risks and opportunities. Our earlier discussion was largely focused on governance issues. Now we will spend more time on environmental and social issues. Here, a major challenge has to do with gathering ESG information. And when we talk about challenges, we need to recognize the fact that when companies report ESG issues such as their impact on the environment or social issues associated with their company performance, the disclosures are inconsistent, which means that it is difficult to compare the information presented by different companies. Also, ESG disclosures are generally voluntary. Therefore, some companies will disclose, others will not, and the level of disclosure will also vary. Then we have materiality. When evaluating ESG factors, we need to evaluate if the information presented is actually material. In other words, whether this information will have an impact or affect a company's operations, its financial performance, and ultimately the valuation of a company's securities. We also need to think about the investment horizon. There might be some ESG factors which are related to a company's performance in the short term. Other factors might be related to a company's performance in the long term. We can use multiple approaches to identify a company's ESG factors. One is proprietary research. So, as an analyst, we can do our own research, or we can use the research that is created by our investment firm or our research firm. We can use information provided by ESG data providers. These tend to be for-profit entities that give data for a fee. We can also use information which is provided by not-for-profit industry organizations and initiatives. There is a difference in how equity analysts deal with ESG information versus how fixed income analysts deal with ESG information. Equity analysts focus on both potential opportunities as well as risk, whereas fixed income analysts are more focused on mitigating downside risk. They do not worry about potential opportunities as much. For equities, adjustments related to ESG factors may be made to cost of capital, price multiple, and terminal value. For bonds, an analyst may adjust an issuer's credit spread or CDS to reflect anticipated effects from ESG considerations. Also, a bond analyst will worry about the short term versus the long term. It's possible that with a given company, the environmental and social issues are likely to impact in the long term, and therefore an analyst might say that the credit rating for this sort of company in the long term is relatively low, but if these issues are not likely to impact in the short term, then the credit rating in the short term might be relatively good. Our final point has to do with green bonds. Green bonds are bonds in which the proceeds are designated by issuers to fund a specific project or portfolio of projects that have environmental or climate benefits. Such bonds generally trade at a premium over comparable conventional bonds, and therefore green bonds will have a lower cost of capital or a lower discount rate. However, we need to recognize that there are some risks associated with green bonds. One risk is called greenwashing. Greenwashing is the risk that the bond proceeds are not actually used for the environmental benefit that is advertised. To mitigate this risk, an investor needs to bear a high monitoring cost. The other issue with green bonds is that their liquidity is relatively low.